If you're wondering what the process of buying a home looks like, this video is for you. The home buying process can be overwhelming. It can be confusing to know where to start. If you're looking to buy a home soon, check out this step-by-step home buying guide that will take you through the basics of buying a house from curiosity to moving day. In this video, we'll review the following steps, and you'll be able to jump to any section in the description below. The steps are determining your readiness to buy a house, calculating your budget and down payment, choosing the mortgage that's right for you, getting pre-approved or verified approved, finding a real estate agent you click with, beginning your house hunt, making an offer on the house, getting a home appraisal, inspection, and gathering all necessary documents, closing on time, and finally, moving into your new home. So let's jump right into it with determining your readiness to buy a home. Whether this is your first time buying a home or you're a seasoned buyer, buying a home is a big commitment. It's important to review your financial health and personal readiness before you start this process. The things you'll need to consider to determine if you're ready is your debt to income ratio, your income, your credit, funds for down payment and closing costs, and personal readiness to be a homeowner. Let's begin with your debt to income. This is the one qualifier used by lenders to determine your ability to repay your mortgage via monthly payments. The ratio compares your combined monthly debt payments by your monthly gross income. For example, if you have an $1,800 monthly mortgage payment, a $500 monthly auto loan payment, you pay an additional $700 in student loans, and you might have other debt like credit cards, personal loans, your combined monthly debt payment would be about $3,000. If your gross income is $10,000, then your debt to income ratio would be 30%. To calculate it, divide your total debts by your monthly income, then multiply that answer by 100 to get a percentage. Continuing with the example we used earlier, the calculation would be $3,000, that's your debt, divided by $10,000, that's your income. Now multiply that by 100, which will equal the 30% debt to income ratio. Still with me? Good. Now, lenders generally prefer a lower debt to income ratio, as this ensures that the borrower will run into less trouble making monthly payments on the loan. Now, according to the Consumer Financial Protection Bureau, a debt to income ratio of 43% or lower is important because that is the highest ratio a borrower can have and still get qualified for a mortgage. Now, the next thing to consider to determine your readiness is to look at your income. To determine your monthly gross income used in your debt to income ratio, lenders require proof of income and employment. Lenders usually like to see a reliable, stable work history of 2 years to back up your source of income. Proof of income can come from a recent pay stub, W-2s, income tax return, proof of alimony, child support documents, or other income statements. Another point to consider when looking at your readiness is your credit score. Now, your score is used by lenders to determine how much of a risk it would be to grant you a loan. Lenders also use your credit score to determine the interest rate you'll pay on the mortgage. Credit scores that are higher reflect a better credit history, allowing you to obtain a better interest rate. Your credit score is typically made up of the following factors: your payment history, your current unpaid debt to credit limit, types of credit you've used, the age of your credit history, and new credit applications. The credit score needed for mortgage approval differs from lender to lender, and it can vary depending on the type of mortgage you're getting. Now, according to Experian, the minimum score usually required for a conventional loan is 620. Again, this varies from lender to lender. Boosting your credit score before starting the home buying process can help increase your chance of qualifying for a mortgage and lowering your interest rate. Continuing with determining your readiness is being prepared for the potential for upfront costs. Now, even if you're financing the majority of your home purchase with a mortgage or you're leveraging a down payment assistance program, it's still important to have some liquid assets to fund part of your purchase, such as the down payment and any closing costs. How much cash you'll need to buy your house can vary depending on a lot of factors, such as the purchase price or financing options. A lot goes into determining your readiness to become a homeowner. Now, be aware that becoming a homeowner is a big commitment. Owning a home can come with many costs that renters do not have to worry about, such as home maintenance and repairs, right? Property taxes, homeowners association fees, and homeowners insurance. Determine if you're ready to switch from renting to owning by using a rent or buy calculator, which I'll put in the link in the description below. This will help you determine if buying makes sense for you. After you've determined that you're ready to buy a home, The second step in the home buying process is calculating your budget and down payment. Now, to calculate your budget, look at your mortgage to income ratio. This is the percentage of your annual gross income that will be devoted to paying your monthly mortgage payment. According to Investopedia, a good rule of thumb is that your mortgage to income ratio should not exceed 28% of your gross income. For example, continuing with the previous example we used, if your gross monthly income is $10,000, your monthly mortgage payment should stay under $2,800, which is 28% of $10,000. Although most home buyers believe that they need 20% down payment to qualify for a loan, that is not always true. The down payment, or the large one-time payment made at closing, will determine how much equity you have in the home at the time of purchase. It also mitigates the loss a lender might suffer if a borrower defaults on the loan. Many lenders do recommend a 20% down payment to avoid additional costs such as private mortgage insurance, but you could put down as little as 0% depending on your loan type. To learn more about down payments, how much you should put down, and saving tips, check out NerdWallet's How Much Down Payment is Required to Buy a House. This resource will be available in a link in the description below. Now that we've covered determining your readiness and calculating your budget and down payment, we're ready to move on to the next critical step, which is choosing the best type of mortgage for you. There are many different types of loans, including conventional, FHA, and VA loans. All loans fall into two categories, conforming and non-conforming. Now, conforming loans meet requirements set by Fannie Mae and Freddie Mac, and the government limits their maximum amount. In comparison, non-conforming loans, their standards differ. These loans can have varying qualification, costs, benefits from lender to lender. Let's start with conventional loans. These are the most common types of mortgage. They refer to any home loan that isn't guaranteed or insured by the federal government, such as FHA, USDA, or VA loan, as an example. There are a variety of conventional loans, but most are conforming loans because they are backed by Fannie Mae or Freddie Mac. Conventional loans allow for down payments as low as 3% and often offer better mortgage rates than their alternative non-conforming options. Next up is FHA loans. These are non-conforming loans that are backed by the Federal Housing Administration, or as you've heard me refer to them, FHA. They offer borrowers flexible credit requirements and manageable down payments. Now, although mortgage insurance will be required for FHA loans, they could be a great option for those who do not qualify for a conventional loan with down payment requirements of 3.5%. Finally, the VA loan is for veterans, active duty service members, and surviving spouses. VA loans can offer low rates and manageable down payments, sometimes as low as 0%. Another great benefit of this non-conforming loan type is that it does not require monthly mortgage insurance payments. To determine which loan type is right for you, speak with a trusted lender who can guide you in making the right choice and help you with the next step, which is getting pre-approved or a verified approval. To solidify your budget and your qualification for loan type you choose, get pre-approved or a verified approval for a mortgage. This step in the home buying process provides you with a letter from the lender outlining how much you're approved for based on your credit score, income, and assets. Now, are you wondering what the difference is between pre-approval and a verified approval? Let's go over it. A pre-approval letter includes a ballpark estimate from your lender of how much money you may qualify for. It typically involves a fast application process where you verbally provide your lender with an overview of your finances. This option is quick and easy, but is not as accurate and can carry less weight than a verified approval letter when included with the home offer. With the verified approval letter, this provides a more accurate estimate of what you may qualify for and holds more weight when it's included with an offer. Although the process can vary between them, this is because your lender will require physical documentation of your income and assets. They may also require you to agree to a hard credit pull. After getting pre-approved or gathering verified approval, the next step is choosing a real estate agent. Now, your real estate agent is a key contributor to your home buying process. They act as your representative, showing you properties, writing offer letters on your behalf, assisting you in negotiations, and keeping your best interests at heart. It's important to find a real estate agent you trust to give you sound advice when it comes to the local market trends and how much you should offer on a house. Now, many home buyers work with a specific kind of agent called Realtors. These are members of the National Association of Realtors, which has its own code of ethics and certifications. Consider interviewing multiple agents in your area to find one that not only meets your needs, but is someone you trust. Finding the right real estate agent can be challenging. To help with this, some lenders may offer an agent match program to help you connect with a trusted local agent. You could also connect with me via the link in the description below. I'm part of a large network of realtors that are knowledgeable professionals and leaders in their area. I'd be happy to provide you with a referral. Now, after choosing a real estate agent, you can begin your house hunting. In this step, your real estate agent will help you find your home. However, you can also conduct your own search. Start by putting together a list of your top priorities or your wish list. Rank your priorities in order of importance so that you know which ones you want to negotiate. Some common house hunting priorities are square footage, the number of bedrooms or bathrooms, the price itself, the home condition, which could be either a move-in ready property or a fixer-upper, the outdoor space, entertainment space, and location, with things such as school districts, neighborhoods, parks, or nearby entertainment. Now, share this list with your real estate agent so that they have a better idea of what you're looking for. When you found a home that matches your wish list, it's time for the next step, making an offer. To make a formal offer on a house, submit a real estate contract in writing. Here are the most common details that are included in an offer: the home's legal address, the buyer and the seller's names, the purchase price and the terms, any earnest money included, which is like a deposit, any requirement for clear title to the property, details regarding closing costs, details regarding the seller's costs and fees the buyer or the seller will be responsible for, the offer expiration date, any list of fixtures or appliances that will be in the property, financing terms, the estimated closing date, and contingencies. Real estate law varies from state to state, so be sure to use an agreement that will be valid in yours and that doesn't omit critical information. If this step seems confusing, don't worry. Real estate agents almost always write and submit the offer on your behalf. After submitting your offer, the seller can respond in one of three ways: with an accepted offer, in which case you celebrate. Your offer was accepted and you can move on to the next step in the home buying process. Or with the rejected offer. There may be many reasons why your offer may not have been accepted, but you still have a few options. You could choose to submit another offer with a few changes, or you could continue the house hunting. And finally, they can respond with a counter offer. In this scenario, the seller wants to leave the door open on your offer. They may come back to you requesting a change in the purchase price or sales terms before accepting your offer. If you receive a counter offer, you could either accept, reject, or negotiate a counter offer of your own. Consult with your real estate professional to help you with this decision. Once your offer is accepted, it's time to move on to the next step in the home buying process: securing financing and finalizing details of the sale. There are many steps to take between getting an accepted offer and closing on the property, starting with the home inspection. Although getting a home inspection is usually not required by your lender, having one is wise. It gives you a better sense of what exactly you're buying. Home inspectors will go through the house and make sure everything is working properly and that there are no issues. They will test electrical and plumbing systems. They'll check appliances, check for anything harmful such as lead-based paint or mold, and inspect other safety measures. The inspector will then give you a report detailing any issues with the home. Keep in mind, any home can have problems regardless of their age. But make sure to go over each issue in the inspector's report carefully, review it with your real estate agent, and ask if they notice any red flags. If the home has any serious problems, such as foundation issues, mold, or asbestos, negotiate with the seller to fix the problem before closing. You will become liable for any issues that are not fixed before closing on the home. This could be very expensive. It's also why many buyers include inspection contingencies in their offers that allow them to exit the contract if the inspection comes back with any issues. Additionally, if a problem is severe, future buyers may not be able to get a mortgage on your home unless the issue is fixed. One additional safeguard may be to add a contingency saying that the seller has to purchase a home warranty for you. These warranties can cover major home components such as HVAC systems and hot water heaters. They can also protect you if something wears out after you've purchased the house. Another critical component is the home appraisal. The home appraisal is a professional review that determines the value of the property you are buying. Your lender will require you to get a home appraisal done as one of the conditions for the loan approval. This gives your lender a limit on how much they can lend you to buy the home. They can't lend you more than what the home is actually worth. If your home appraisal comes back lower than the purchase price, the lender will not cover the full amount. If this happens, you can ask the seller to come down on the price, or you could be held liable for coming up with the rest of the money. Most buyers include a home appraisal contingency for this reason. This enables you as the buyer to cancel the purchase contract if the home appraisal comes back lower than the agreed selling price. Finally, during this step in the home buying process, the lender will require mortgage documents, such as the purchase contract and proof of income, before finalizing the loan. Having all the documents your lender requires ready to go ahead of time can help speed up the process and keep you organized. Which documents you may need varies depending on your financial situation as well as your lender. To get started, I've included a checklist of commonly required mortgage documents in the description below. The next step is the closing on time, which could be one of the busiest steps in the home buying process. It's important to know what to expect so that there are no surprises on signing day. 3 business days before closing, your lender will provide you with a closing disclosure. This document summarizes details about your mortgage, such as your loan terms, monthly payment amounts, and the closing costs that you will need to pay to finalize the mortgage. Review your closing disclosure to make sure there are no mistakes or that there are no issues. Bring a copy of your closing disclosure, your ID, and the closing cost funds when you attend the closing. At this meeting, you're going to sign a settlement statement that lists all the closing costs associated with the purchase of the home. You're also going to sign the mortgage note promising to repay the loan, and you're going to pay the down payment and any other closing costs. You will also sign the deed of trust to the house, which secures the mortgage note and makes you the official homeowner. Now, the final step is taking possession of and moving into your new home. There can be a lot of work and expense that goes into this step in the home buying process. However, there are many ways you can reduce moving costs to help make this step a bit easier on your budget. Schedule your movers during low demand times. Now, you could also collect free boxes and supplies, and get rid of items that you don't need. You could also use existing items as packing supplies, such as blankets and towels. And finally, you can search for free or discounted moving programs. Whew, you made it to the end. Now, do me a favor. If you made it this far and you found this content useful, please like, comment, and subscribe to my channel. That way, you'll be notified if I share any more content in the future. If you have any questions, don't be shy to reach out. Thanks for watching.